Before the worst of the sovereign debt crisis, what does he see now? We're about to find out. Gary Shilling, president of Gary Shilling, joins us. Gary, my goodness, you've had some good calls over the years, and we're waiting to see if this one proves to be accurate. Over the weekend, $1 trillion rescue package for the euro engineered by the EU and the IMF. In your mind, does this make the outlook for the euro any better, any worse? And if it's either way, how much?
Well, in the words of the late Senator Dirksen, $1 trillion here, $1 trillion there, and pretty soon you're adding up to real money. I think this is a socialization of debt. It papers it over. They're really trying to come in with shock and awe and say we got enough. We got a big bank account. And if you read the fine print, the thing is even open-ended beyond that. But does it solve the basic problems? No. Does it make the Greeks follow the Teutonic North in terms of discipline? No. It's still the Club Med South. I think it may buy some time here, but it doesn't save the problem. And now we got the other pigs lining up, of course. You know, Portugal, Spain, Ireland is already in trouble, Italy, and so on.
But they're all touting their fiscal austerity measures. I mean, we spoke with the Portuguese finance minister on the phone from Lisbon, and you're going to tell me he's obligated to say that. But don't you think that the rest of the countries that have seen Greece take Greece seriously as a cautionary tale? I mean, they don't want rioting in their streets.
Well, they don't want rioting in their streets, but if they were going to discipline themselves, why didn't they do this years ago? I mean, is this Paul on the road to Damascus? Are they suddenly the lightning bolts come down and they're changed countries? I doubt that seriously. The character of these countries is deeply embedded. I doubt there's any sudden change.
Well, we know you like the dollar, so I mean, do you still see parity as the worst-case scenario for the euro?
Well, I think it's a reasonable forecast. I don't know if it's worst case, best case, but I think it's a reasonable number. I mean, after all, when the euro was initiated in 1999, it started off, I think, 110, went down to 89. It's already been there. I mean, then it went to 150, but you know, this is just going back to where we were in a sense.
Gary, people like to talk about how markets enforce discipline, how it's things like credit spreads widening, currencies depreciating, forces countries into action. We've seen it happen, but we've also seen similar actions take place here in the United States following the deep market declines that we had in late 2008. Happened again last week. The Eurozone is spurred into action. Does that raise some questions, though, about whether stocks are becoming a kind of riskless asset in the sense that every time the stock market craters, politicians are going to jump in with some kind of rescue package?
Well, there has been that pattern. There certainly has that pattern. But, you know, there's a big difference when you go back to Europe between what they're doing on a community-wide basis and what individual countries are doing. And I think the big difference between that and the U.S., the government really bailed out the private sector, the banks. In the case of Europe, it's the supranational bodies, the EU and the Eurozone as a whole, bailing out individual countries. And it isn't the private sector, it's the countries themselves. And it's a different twist on it, but there is kind of a too big to fail in there, unfortunately.
Gary, we don't have a ton of time left. We know you've been good enough to stay with us through the break, but we spoke with Thomas Mayers, an economist at Deutsche Bank earlier, and he proposed this idea of an EMF, a European monetary fund that would be separate from the EU that could issue its own debt. Would that go towards solving any problems long term?
Well, that just means that they would formally do what they're already pledged to do. I don't think it's how. I mean, the basic problem. So you can see that as an administrative tweak and nothing else.
If
the Greeks think they deserve the public officials 2 months extra pay every year, that they can retire at age 55, et cetera, et cetera. I mean, they are competing with other countries, and when other countries are willing to work till 65 and work, you know, 40 hours a week, et cetera, that's a very different kind of competition.